Welcome to the Deep Dive. Our mission is to distill these massive earnings calls and dense research notes into immediate, practical knowledge for you. Today, we are digging into the second quarter of fiscal year 2026. Results from the intelligent data infrastructure provider, NetApp.
And these results, they dropped right after the U.S. market closed, and they really delivered a classic tension point to the street. On one hand, you had this extraordinary profitability surprise, all-time high operating margins. But on the other, that was paired with a really cautious outlook on near-term revenue.
That tension is exactly what we need to unpack.
Yeah.
We're going to figure out how they achieve these record margins despite, pretty modest top-line growth. We'll also measure the genuine acceleration in their AI strategy and critically identify the single biggest headwind that kept investors from really celebrating that phenomenal beat.
Let's start with that immediate snapshot. The numbers on the surface looked fantastic. Non-GAAP earnings per share came in at $2.05, which just obliterated the consensus estimate of $1.89. That's a full 16-cent beat.
Wow, that's nearly a 9% bottom line surprise. That kind of beat, that usually sends the stock immediately higher.
And it did, initially. But the overall picture quickly dampened that enthusiasm. On the top line, net revenue was $1.71 billion. It topped consensus, but just barely.
And what was the growth rate?
That's the key. It only represented 3% year-over-year growth. And if we adjust for the divested spot business, the underlying growth was still only about 4%.
Right. So management correctly highlighted the performance they called Q2 outstanding. And it really was, but driven entirely by execution and profitability. We're talking about operating margin and EPS both setting all-time company records.
Correct. And when those numbers crossed the wire after hours, the stock did spike. It was up about 5%. But as the detailed guidance came out and traders started running their models against that, 3 to 4% growth rate, the enthusiasm just vanished.
It pulled back significantly.
It did. So we really need to answer why the market chose to focus on that modest growth pace rather than those undeniable record-breaking margins.
Exactly. If the execution was so strong and led to such a fantastic EPS beat, why didn't that translate into better top-line growth? This profitability story is central. So let's unpack it. How did they manage to achieve a 31% operating margin in a business that historically has been seen as pretty commoditized?
It was pure strategic discipline. It really shows a definitive choice to prioritize high-quality, high-margin revenue over just raw volume growth. The metrics here are just phenomenal. Non-GAAP gross margin reached a record 72.6%. That's up 60 basis points year over year.
And the operating leverage, I imagine, is even more impressive.
Absolutely. The non-GAAP operating margin hit 31.1%. And to put that jump into perspective, that's about 240 to 250 basis points of expansion year over year.
Okay, so this isn't just incremental improvement. This is a structural re-engineering of the P&L. What were the specific levers driving this massive expansion? Because you're right, a 31% op margin for a data infrastructure provider is exceptional.
The primary driver is a strategic structural mix shift. Leadership pointed out that their all-flash array revenue and their public cloud services now make up roughly 70% of total revenue.
And those segments just carry higher margins naturally.
They carry much higher structural gross margins than the legacy hybrid and traditional hardware portfolios. They are actively optimizing their portfolio toward services and high-end flash.
That makes sense. They're focusing on selling the most profitable pieces, even if it means overall volume doesn't accelerate wildly. But is that sustainable?
This is where it gets really interesting, and it points to a crucial competitive advantage. Management confirmed a detail that gives their margin confidence real durability. They have successfully locked in key component prices.
You mean things like NAND flash chips?
Exactly, the volatile stuff. They've locked in prices through the end of the fiscal year.
That visibility is huge, especially right now.
It is. This strategic lock-in basically shields them from the price fluctuations that are hammering some of their lower margin competitors. It gives them confidence that product gross margins can stay stable in that mid to high 50% range.
So if we look at the old NetApp, it was a volatile, cyclical stock tied to hardware cycles. The new NetApp seems to be relying on annuity services, a high-margin software mix, and really strategic cost management.
Precisely. This structural discipline is what transforms the identity of the company. It's moving from that cyclical hardware vendor to what we'd now classify as a profitable compounder. By delivering these margins and securing their costs, they were able to raise their full-year non-GAAP EPS guidance to a midpoint of $7.90.
Which implies what? Mid-teens EPS growth?
Mid-teens EPS growth, even on modest revenue expansion. Profitability is absolutely the new engine.
But the market is clearly skeptical. If they keep prioritizing margins over raw market share, aren't they just, shrinking gracefully, giving high-growth competitors an opening?
It is a valid challenge, but let's look at where the growth is actually happening inside that profitable portfolio. Let's shift from the margin story to the growth engines, all-flash and cloud.
Okay, starting with all-flash array revenue. That's the bread and butter of enterprise transition right now.
And that segment continues to be a cornerstone. It grew 9% year over year to hit $1 billion in the quarter.
$1 billion. So that's a $4.1 billion annualized run rate.
Exactly. And it also cements that structural shift in their customer base. Almost 46% of their installed support base is now using all-flash systems.
That shows the enterprise transition to flash is moving at a very steady, predictable pace. Now, the cloud engine, this one was a little confusing. Public cloud revenue headline growth was a weak-sounding 2%, which I think caused some concern.
You have to read the fine print. The asterisk is that divested spot business. When you exclude that, public cloud revenue accelerated to a much healthier 18% year-over-year growth.
Okay, that's a very different number.
It is, but the number you should really care about, if you're looking at the long-term thesis, is the growth of their highly differentiated offerings.
You mean their first-party and marketplace cloud storage services?
Exactly. Those unique services, which offer a unified data platform inside AWS, Azure, and Google Cloud, grew a very healthy 32% year over year. That segment validates their unique hybrid cloud position.
Okay, this brings us directly to the central, most forward-looking theme of the call, AI.
Strong demand for their AI solutions was a central narrative, and they're translating it into concrete deals. They reported closing approximately 200 AI infrastructure and data lake deals in Q2.
200 deals. That's a big jump from the roughly 125 they closed last quarter, so the pipeline is growing.
And the product stack is clearly resonating. They highlighted launches like NetApp AFX, their ultra-scalable platform, and the AI Data Engine, or AID. These tools are designed to simplify those complex AI data pipelines.
What's the flavor of those deals? Are customers building massive training clusters yet, or is it still foundational work?
It's still weighted heavily toward preparation. The deals broke down roughly as 45% focused on data prep and data lake modernization.
Okay.
25 to 30% for model training and fine-tuning. The rest is for RAG and inferencing workloads.
And for our listeners, RAG, retrieval augmented generation, that's critical. It's the process of linking a large language model to a company's own proprietary data to make it useful.
Right. It's the fastest path to getting these AI models operational and producing accurate results. And it requires high-performance data infrastructure.
So the deal mix makes sense. The CEO noted that the timeline for that massive storage build-out, the truly enormous revenue-generating stuff, is still dependent on inferencing becoming a bigger part of the AI landscape.
That's the consensus. The AI momentum is real, but the bulk of that big infrastructure investment is probably a fiscal 27 or 28 story. NetApp is positioning itself for that wave.
All right, let's connect this long-term view to the immediate challenge. The guidance and that specific headwind that spooked the market. First, what does their long-term visibility look like?
They have excellent multi-year visibility. Their remaining performance obligations, or RPO, stand at a strong $4.9 billion.
Okay.
Deferred and financed unearned revenue is $4.5 billion, up over 8%. And crucially, their consumption model, Keystone, saw its unbilled RPO grow 39% year over year.
So the pipeline for recurring revenue is very healthy.
Very healthy.
Then with all that backlog, why was the Q3 revenue outlook so conservative?
Right. Q3 revenue is guided to $1.615 to $1.765 billion. That implies a conservative midpoint of just 3% growth or 5% ex-spot.
So why the caution?
Management explicitly flagged one specific isolated risk: softness and subseasonal performance in U.S. public sector spending.
So a government spending issue, likely related to the recent shutdown and budgetary delays. Is this typically a one-quarter fix?
Historically, these delays tend to cause procurement headaches that spill over for at least a quarter, sometimes two. Management clearly views this as temporary, though.
And you can tell they do because despite the Q3 caution on revenue, they raised their full-year non-GAAP EPS midpoint to 790.
Exactly. They're telling investors, look, we know Q3 revenue looks soft because of a temporary government issue, but our margin story is locked in, our costs are fixed, and therefore our earnings are secure.
Okay, so tying this all back to the market reaction, the stock pulled back. Investors are weighing these record margins and aggressive capital return against that core growth rate. Why did 3 or 4% growth matter so much?
It's all about sector comparison. The company's 3 to 4% underlying growth is simply below the projected growth for the broader enterprise storage market, which is expected to grow, 5.5%, maybe 6% next year. NetApp is lagging the average.
So the market is questioning the sustainability of premium margins. If you're only growing at half the rate of your sector, sustaining premium pricing becomes really difficult, regardless of how good your profitability is today.
That's the split decision we saw. Initial enthusiasm for the EPS beat gave way to skepticism. And that 2% pullback, coupled with a massive 287% jump in trading volume for NetApp put options, it suggests investors are actively hedging or questioning if that premium valuation multiple can hold if the top line stays stuck in the low single digits.
It's the classic battle between value and quality of earnings versus just pure, unadulterated growth.
All right, now for the segment where we explore the most provocative implications of all this data. This is not financial advice. Right, so if we take the perspective that the market is over-discounting the durability of this margin story and over-focusing on that temporary public sector softness, there is a highly plausible trade idea here.
Let's call it the arbitrage of quality trade. Lay out the premise.
The premise is simple. NetApp management successfully de-risked their cost of goods. By locking in those component costs, they essentially secured their high margins, making that raised 790 EPS target highly reliable. The market, however, is still treating them like a cyclical, low-margin hardware vendor.
So their earnings are dependable, while their peers' earnings might be vulnerable.
Precisely. The trade idea would be to initiate a long NTAP/short storage peer basket hedge.
Okay, how do you build that hedge to capture this quality spread?
The long side is straightforward. You go long on NetApp, you're betting that this consistent, high-margin, capital-returning story is going to appeal more and more to defensive tech and quality investors. This should ultimately push its price-to-earnings multiple higher, aligning it with its new status as a profitable AI infrastructure compounder. You're betting on a re-rating, not a demand acceleration.
And the short side hedges against general sector risk.
More specifically, it targets the vulnerability of others. You would simultaneously short a basket of lower-margin storage peers, the companies whose margins haven't been locked in.
So they're vulnerable to the same component cost pressures that NetApp navigated.
Exactly. If supply chain volatility hits, their rivals' earnings get squeezed, but NetApp's margins hold up. That widening spread between their execution and their exposed rivals is where the alpha is found.
That is a fascinating strategy. It uses management's operational execution, that price lock-in, as the core thesis. A very elegant bet on relative financial quality.
That's the pitch.
Excellent. As we wrap up this deep dive, the key takeaways are crystallized. Record margins, strong but early-stage AI momentum, and a cautious near-term revenue stance due specifically to government spending.
And the question for you, the listener, and for our next deep dive is whether these record margins are a temporary victory lap or the new, higher floor for profitability. The core conflict remains. Will this financial quality be rewarded with a higher valuation, or will investors demand revenue growth closer to the market rate before they truly buy in?
A difficult balance to strike. As always, remember that everything we discuss here is for informational and entertainment purposes only. Please do your own research. Let us know how you view that quality of earnings versus growth trade-off. We'll be back soon with another deep dive.